Well, it's the beginning of 2021, and it looks like 2021 might turn out to be somewhat of a better year than 2020. Don't know how it could get much worse. But hopefully, as the year goes on, things will continue to improve. Slowly, maybe not so surely, but they'll get there. In the meantime, I think it's fair to say that there is not a thinking person out there that hasn't spent time contemplating where they are, what just happened, what the meaning of it is on a larger scale, and where you as an individual and as a financial advisor just might figure into it. Some things are still the same. Many things have changed for good. My personal feeling is that we will not go back to what I like to call the before times. We're not in the after times just yet, but you can kind of see them off in the distance. And it's going to be different. We know that. And I think from the standpoint of professional financial advice, we're coming in to the best period we possibly could. Now, for those of you that are concerned about the froth we've seen recently in stocks that apparently had large short positions and were bid up by retail investors, which may have interested your clients one way or another, please keep in mind, and this will be no surprise to those of you that have been around a while, this stuff is not a feature of the markets, it's a symptom. And it's a symptom of a top. It's a symptom of too many people with too much spare cash and too much time on their hands trying to find ways to exploit, if you will, a system. We should leave all the exploitation to the institutional traders since they've got faster computers than we do. By and large, my personal opinion is that any hedge fund I've ever owned, personally or on behalf of clients, I have found that the illiquidity and the gates and the overall return, less the fees, doesn't even come close to what I was able to do in plain old ETFs, index funds, or professionally managed long-only accounts. You make your own choices. But anyway, that's an aside. How you manage your money on behalf of your clients is up to you. Personally, I found it somewhat mundane. I found I was better off jobbing it out to people that could focus on it full time because they didn't really get paid to do that. What I got paid to do was hunt. What I loved to do was hunt. Not in the way a lot of you are doing it, which I still can't believe relies heavily on cold calls or some kind of truncated, screwy referral solicitation. I like to hunt intelligently. I would look at what the mass of people were doing for prospecting and try and find things that not only were different, but had a certain degree of intrigue to them, had a certain degree of interest that I could have a discussion with a potential client and have them asking me questions and me asking them questions in exchange. And there's a real kind of contemplation of value in a discussion like that. So I thought I'd take a few minutes and talk to you about what I did for 35 years of my career to build a $4.5 million book, but more importantly, what my coaching clients are doing right now, many of whom are $1 million plus producers that are rediscovering just how interesting it is to go out and not only identify assets you don't have from your current clients, but also find out how those current clients are more than happy to introduce you to people that they know that you can have a conversation with and probably have a very high probability of walking away by converting a prospect into another terrific client. So I'm going to kind of call this little bit a pragmatic approach to convert qualified prospects to great clients. You can name it anything you want. The only thing I ask is this. If you decide to use what I'm about to say, and you note I don't put in here in case it works, because I know it does. When it works, what I'd like you to do is just leave a comment below this video. Let me know it worked. Give me a thumbs up. Like the video. Hit the subscribe button. All this stuff is free for now. But the only thing I ask in return is if this works for you, let me know. Not a big question. Okay, let's go. All right, let's look at two issues you likely have on your book right now. Number one, If an FA from a competing firm were to ask one of your best clients how the investments you have recommended relate to the return on investment needed to meet all of that client's goals with as little risk as possible, what would your client say? And here's the answer you don't want. I don't know. He just takes care of it. Or I'm not really sure. She calls me when she wants to do something. Should I know that answer? There's all sorts of things you're going to hear if someone were to ask your clients that. What would they say? In a minute, we're going to talk about how you can ask somebody else's clients that. Here's the other one, that if you got the guts to do it, I strongly recommend you do. This gets into other issues I'll cover in other videos, but if you were to ask your top 5 clients to describe how you add value, would they all say the same thing? And would your bottom 5 clients recognize you by any of those descriptions? Now again, I'm not trying to make you feel bad. We know you haven't talked to your bottom 5 clients in God knows how long, but at one point they were really important to you. Your top 5 clients, depending upon your relationship with them, should have a consistent statement of how you bring value into their lives. If they don't, it means you've got other issues that you need to focus on. So let's think about this a little bit. I built a huge business and have trained thousands of advisors to build books by taking clients away that cannot answer question number 1, or will give 5 different answers to question number 2. Sometimes I would find that it may have been just a miscommunication. Maybe the client really did have that answer. And by the way, the FA was doing a good job. I was hands off. I would leave it there. There's so few FAs out there that are actually doing the right thing, managing risk the right way, talking to their clients so their clients become raving fans. But when I found that, I would leave it and tell them, go on your way. Fortunately, I didn't find it much. So let's think about it this way. One of your top clients refers a close friend. On the initial Zoom call, you learn the following. She's got an annual income of $600,000, a portfolio of $5 million. Financial plan completed by her advisor 5 years ago and updated 6 months ago. All the assets are titled properly. There's an attorney involved. 60-30-10 basically is mapped to the client's clearly stated goals and financial plan. There are 5 professional money managers in place to achieve diversity of size and style, and more importantly, they own real bonds, not a bond fund, not anything that doesn't have a maturity date, and a coupon. For those of you that own open-ended funds and you think they're fixed income, take a look at other areas of the channel and find out why you want to get the hell out of those as quickly as possible. It's amazing how we're talking about inflation coming back in to the market right now, and the bond market is leading the way. The FA recommends rebalancing on a regular basis to an asset allocation that is mapped to those stated goals. Oh, and the FA speaks with her client 9 times a year, and quite often, they don't even discuss what's going on in the portfolio. They discuss what's going on in the client's life. Interestingly enough, quite often, the client asks the FA what's going on in her life. This is where clients rate you as giving exceptional service. So there's 2 questions that we want to pose. First one is, how are you going to win this prospect over? What's your move? You got the appointment. What are you going to do? Well, you have to wait till the end of the video to find out, because this was actually a prospect that I had, and I'll tell you exactly how I won it shortly. But what would you do to convert this prospect? Good question, isn't it? Are your clients this well insulated from your competition? And if not, why the hell not? What are you doing? Because if somebody like me shows up and starts asking those questions, or someone I train, they're going to take a client away from you if that client, your client, can't answer the questions. So the way I do it, and the way I still teach it, is by creating constructive doubt. I am not a big believer in telling people any of this stuff. Describe your value prop. Are you kidding me? I've seen so many coaches that work with FAs. Let's develop a firm value proposition. And then the FA makes 300 calls trying to describe his value proposition. Oh, by the way, when's the last time you ever won an account? By describing your value proposition. Why do you think prospects become clients? It's not your value proposition. It's also not your ability to forecast near-term market moves. You know why? Because you don't know what's going to happen. You can act as if you know. I hear this nonsense all the time. You don't know. And if you knew, who the hell would you tell? You wouldn't tell anybody. If you get hold of a DeLorean and a flux capacitor and you get Doc Brown and you can go back in time, then you're onto something. And then you probably wouldn't tell anybody anyway. What else shouldn't you do? You shouldn't talk more than the other person. You got two of these. You got one of those. I used to sit there with a stopwatch and time in the aggregate how much I spoke and how much my prospect spoke. And I did it on client calls as well. When you give people a chance to talk and an avenue that feels safe, they will pretty much tell you what you want to know. But it won't work if you ask closed-end questions. Do you invest? Yes, I do. Why did you buy this? To make money. Do you want to buy more? No. I mean, what is this? People are on the phone, prospects are on the phone. They don't want to talk about that. What are they learning from you? What's in it for them other than giving you information? They don't want to do that. What they want to do is they want to gain information from a call. That initial exchange of value with a prospect that you talk to for the first time has to be a value exchange. It cannot be a sales pitch. It cannot be an elevator pitch. It cannot be describing your value proposition or telling them how great your firm is and how wonderful the research is and all this other nonsense. Get over it. You work for a buy-side firm. That's what they do. They'll put positive opinions out on stocks they like. They won't put sell opinions out because they'll never get investment banking business. And you're going to sit there and basically pitch what the institutional guys are writing about. Doesn't do a damn bit of good as far as getting clients to their ultimate objectives. How do I know that? Because most of you aren't even talking to your clients about why they own what they own. You have an idea, you put it in. Does it fit? Does it not fit? Who knows? If it works, great. If not, we'll try something else. I stopped doing this stuff on the left in red probably by my third year. That was the year I hit 650, did 380 the year before, and then the following year I did 880. And I never talked about any of that stuff ever again. What I did was this. Mr. Prospect, when you look at your investment performance, what do you compare it to figure out if you had a good year or not? Do you know what annual return on investment will get you to all of your goals? Can you correlate what you own with that return on investment? Does your advisor have a strategy to manage risk? Here's my favorite. Can you define risk in less than 7 words? I will tell you, each one of these questions, asked independent of the other, is going to introduce in the client's mind the following thoughts. This sounds like something I really should know, but I really don't. Okay, why is that important? And how do you explain that again? And what does that mean? When you look at your investment performance, what do you compare it to? Well, if they compare it to an index or their buddy or what they heard on TV, they're judging the investment performance subjectively. It's how they feel about what they're doing, not comparing it to a preset return on investment that you have figured out with them gives them the highest probability of achieving their goal with the lowest level of risk possible. If you caught the video that I talked about the immutable strategy and logic of the A to B process, and you saw those spreadsheets, which by the way I've just updated, you can see clearly the logic of following this predefined mapped to goals approach. Do you know what annual ROI will get you to all of your goals? Most people have no clue. Well, I guess we're doing okay. I think we're on track. I saw some Monte Carlo simulation that said things were looking okay. By the way, did you know, as an aside, in most of these financial plans, they set the tax rate on equities at the ordinary income rate? So if you assume an 8% return annually in your equities, that financial plan, because the compliance and law people think this is more conservative, is going to roll those stocks 100% each year and reduce it by your ordinary income rates. If you think that through, that causes most financial plans out there to force the client into a higher equity exposure to make up for the taxes that they think are going to be coming out, which absolutely don't. If you don't know in your planning software what the annual turnover is on your equities and you're not setting it to the number you want, boy, are you making a mistake. From a prospecting standpoint, that one's solid gold. Oh, I got a plan. It's this, it's that. It's all great. Great. Do you understand whether or not or how much in taxes are being taken out each year from your equity returns? No. May I see a copy of your plan? Or why don't you give your FA a call and I'll give you a call back tomorrow and find out? Because even not knowing how you're invested, you may be taking far more risk than you need to. And if Mr. and or Mrs. Prospect, you have an interest in taking as little risk or uncertainty as possible, we should have a conversation once you get the answer to that question. Can you correlate what you own with that ROI? If they start looking at individual securities and try and correlate, it's not going to happen. How do you do a correlation? Asset allocation and rational capital market expectations. Does your advisor have a strategy to manage risk? My guess is once you tell your prospect the actual definition of risk, the next time they ask their advisor if they can define risk, they're going to find out their advisor does not know how to define risk. Risk is simple. Possibility of loss, damage, or injury. It's 6 words. Want to put a "the" in there at the front? It's 7. That's it. Everybody gets it wrong. Everybody tells you how it feels. Everybody thinks about what it does to them, what I could have made, what I lost. It's all wrong. I used to have my clients, my prospects, ask their advisor, how are they defining risk? They didn't even have the brains to go look up on the internet and see what Webster says. It's right there. So let's go back and think about this a little bit. How did I get this client who seemed so set on where they were going? Bottom line was, this was a face-to-face meeting that I had. I had no idea why I was there. I actually got to look at the portfolio before I met with the client who still wanted to meet with me. Client was in the commercial construction business. He's a pretty sharp guy. In this case, I changed the gender to she. He or she, doesn't matter. But in this case, this client was entertaining proposals from at least 3 or 4 other brokers. I saw a pitch from Morgan Stanley. I saw a pitch from Pru. I think I saw a pitch from Goldman Sachs. And each of the pitch books were like this. And I was last at bat. And I basically came in with a legal pad, or contained in my trusty 1,000-year-old Merrill Lynch leather folder. And my conversation went like this. As much as I would love to have your business, I have been through your portfolio and looked for areas that I could actually offer improvement. The bottom line is I can't. Whatever you're doing, whoever you're dealing with knows what they're doing. They've taken great care of you. And other than maybe give you some suggestions at the margin, which aren't going to really mean anything, there's not much I can do. So the client sits back, says, you got transfer forms in that briefcase you brought in with you? Remember, this was a while back. We carried briefcases. I said, yeah. Get them out. Now I'm like mystified. So I take out some ACATS forms. He says, what do you need to know? I start filling them in. He goes, tell me where I have to sign. And I'm like, what the hell's going on here? Many of you may have heard this story. He said, so I'm not transferring the assets to you because I think you're going to just do a phenomenal job. What I do know is that you're the only guy that has come in here and told me the absolute truth. I know I've been covered incredibly well by this FA. He's one of my best friends. Unfortunately, he's retiring. He's given the book to his son, and his son is a putz. And I don't want to deal with him. Everybody else came in here and told me how many things I was doing wrong. I listened very patiently. They keep calling. You're getting the business. And I walked out of there with more lessons that I reflected upon in the years ahead than I could possibly imagine. But back to what we talked about before. What would you do if that wasn't the case and you ran into a client that was this well protected? Answer is you're probably not going to get them. What are you going to do if your clients aren't this well protected and somebody like me shows up? Odds are you're not going to have a great day. This is Gary Cinderbrand. Thanks for your time.